To be honest with you, I've been avoiding doing a points video for probably about a year now, but I think it's very important that I do this video so you understand, even as a real estate agent, I want to try to give you some perspective about how points work so you're better prepared when you are looking over loan estimates and when you're talking to lenders. And I'm also going to put in the description 3 videos from YouTube that I think would add to your amount of understanding of the point process. Because one thing I wanted to point out is that every lender does it a little bit differently. What they charge for points might be a little bit different. If they quote up front with points, may be a little bit different. So I think by watching this video to give you an overall perspective on points, and by watching the videos in the description, you should be confident about how the point process works. I'm Shaheedah Hill, getting you over the hill to home ownership and helping you confidently buy your first home. So what are points specifically? And they're called different things. So you'll see them as points, you'll see them as discount points, and you'll see them as origination fees. But they allow you to either pay more to get a lower interest rate, or to pay a higher interest rate and perhaps get a lender credit for paying a higher interest rate. I think the problem comes in when lenders don't quote with no points. That's called a par rate. What would your interest rate be on your mortgage if there were no points and no origination fees quoted? And so I want you to begin there. If the lender is quoting you an interest rate, you need to ask, is it the par rate that you are quoting me? Are there any origination fees, or are there any points on the loan? So I made this little table, and I'm not putting exact numbers because, again, some lenders charge different amounts for points. So you have to be mindful of that. And that's why it's so crucial. In all of my videos, I tell you to get at least 3 quotes, because every lender is going to be different and every lender will not give you the same interest rate. So I want you definitely to quote with 3 lenders, and then I'm going to go over on this table how it could look with a lender. So lenders have rate sheets that come out every single day. So every day rates change with the markets. So every day lenders get rate sheets. So depending on when you contact the lender, it may be one rate that you're quoted one day, and then maybe a week later, it'll be a completely different rate that you're quoted, because rate sheets come out every day. And this is a simplified version of what this rate sheet might look like. So based on your credit score, your down payment, your loan type, FHA, conventional, USDA, VA, whatever your loan type is, whether you're getting a 30-year loan, a 20-year loan, a 15-year loan, all of those factors factor in to your par rate. So you'll get a rate sheet like this, and if you don't want to pay any points, any discount points, any origination fees, they can quote you a zero-cost loan. So for example, based on your credit score, your down payment, your loan type, and your the term of your loan, you were quoted a 3% interest rate. It includes no points, 0 fees, and your principal and interest payment, and I did a $100,000 mortgage, would be $422. Okay? And why points are important is because it will, if you pay points, that will increase your closing costs. And a lot of people don't want to pay a lot of closing costs. So that's important to note. Now, if you want a lower interest rate, you can pay points. Those points are equal to 1% of your mortgage. So for this example, a $100,000 mortgage would be $1,000. So you can pay a full point, you can pay a percentage of a point. So you can pay to get your mortgage rate lowered. And that will cost you money. So if you want to go to a lower interest rate, you can ask the lender, if I want a lower interest rate, how much will it cost me in points? I think another problem that comes in, and this has been my experience, I've been on the phone with lenders arguing this point with them. They quote a lot of times with points or origination fees up front. So before you're even able to discuss it, they've already quoted you a price that included points. And sometimes they will say, well, the borrower said, I don't want to go over this amount in my mortgage payment. So in order to give you a lower mortgage payment, they increase your closing costs, or they added discount points to give you a lower rate and a lower mortgage. So that sometimes happens. If you start out asking the lender, what would be my rate if I didn't want to pay any points? What's my par rate? That means no cost, no discount points, or without origination fees. What would my rate be? Then you're comparing, when you get those three quotes, you're comparing apples to apples, because somebody can give you a lower interest rate, but then you're paying points, and that's going to amount to higher closing fees. So be mindful of that, how they're quoting you, and ask them, does this rate that you're quoting me include any points or any origination fees? And if you don't want to pay those, tell them, I don't want to pay those. What would my interest rate be without them? And that's when they should quote you. If they didn't up front, they should quote you the par rate. So that's an example. If you want a lower interest rate, after you get the par rate, what you'll get based on your credit score, your down payment, your loan type, and your term, how many years the mortgage is for, and whether it's residential or investment, that sort of thing, you want them to quote you a rate with no points to begin with. And then you make the decision. This is my recommendation. Then you make the decision whether or not you want to pay points. If you pay points, you'll get a lower interest rate, and that will amount to a lower payment. However, for this example, so say you paid some points and it went from a 400, this is only principal and interest, not taxes, insurance, all of that, because that doesn't change. But in this example, you're only saving about $14 between the 422 and the 408. So what you have to say to yourself is, how long before I break even? If I have to pay $1,000 to save $14 a month, I'm going to take $1,000 divided by 14. It's going to take me 71 months in order to make that payment, make that $1,000 back to break even. That's your break even point. Divided by 12, that'll take me about 5 years, 9 months in order for me to make that $1,000 back. So in this example, I wrote some other notes on this side. Definitely talk about the par rate. That's the par rate with no points or no discount points and no origination fees. And then what is my break-even point? If you decide to pay points, how long will it take you to break even? Because you're going to give them that $1,000 at closing. You pay that money up front to save a certain amount of money every month in your monthly payment. The fewer amount of years, the better. On average, even though you think up front that you're going to stay in this house for 30 years, a lot of people sell or refinance before then. So you're going to pay this money out. You want to make sure it's going to be a short time before you're able to make that money back. You don't want it to be 5 years, 6 years, 7 years, and you paid this money, but you haven't even broken even until, 5 years later. Okay, so just be mindful of that when you do your math. How soon can you break even based on, and the more expensive the property is, again, it's going to be different math, but you want to make sure that you know that break even point. You know how many years it's going to take you in order to break even, because with the money that you're putting up front at closing, there are other opportunities, opportunity costs. It's the cost of other alternatives that you're going to miss out on. For example, could you save that money, to have it for your emergency fund? Could you invest that money? So if it's significant enough, what happens if I put $1,000 in an investment for 5 years, 7 years? How much money would I have then? And then should I put that money instead toward my down payment? You need to think about all of that before you decide to pay any points. And that's a discussion that you should have with your lender. And number one, you need to make sure you understand it up front, and then have those discussions with your lender. Now let's talk about the opposite of paying down. So the opposite of paying down is, okay, so you pay money, and then they give you a lower interest rate. However, what if you want to save money? That's where lender credits come in. So you can take a higher interest rate, and I put that here. If you pay, instead of 3%, you say, I'll pay 3.25%, or I'll pay 3.5%. Then that lender can give you a credit towards your closing costs, and then you don't have to pay as much for closing, because now that money can go toward your taxes, your insurance, whatever you have to pay for your closing. That lender will give you a credit, and your mortgage payment will go up. For this example, it's between $422, it goes up to $435. But that's another example of how you could possibly pay less at closing if you take a higher interest rate. But again, you want to see, does that make sense for me to pay this extra amount in order to get less at closing? Sorry, in order to pay less at closing. So I hope this was a good starting point for you to have an informed conversation with your lender about whether or not you want to pay any points. Points, discount points, origination fees, they're all the same thing. They're additional fees that impact your interest rate. If you have any questions, please watch the other 3 videos that I recommend, and I want you to ask them in the comments. Thank you so much for watching. I hope this helps you make a better mortgage decision.